Hello guys, it's just your favorite forest guy, Michael Chukwu, and welcome to my channel. In today's video, I'll be talking about psychology in trading. I've talked about strategies, I've talked about how to apply risk management, and most importantly, the aspect that most newbies in the forex industry tend to ignore is the aspect of psychology. They do ask themselves this question, which I myself have also asked myself this same question. Why is psychology important in trading? It's not about making, it's trading not all about making money. Yes, you are right. Trading is all about making money, but money is the end product of trading. Before you get to 10, you have to count from 1, 2, 3, 4, 5, 6, 7, 8, 9. Then you get to 10. And before you get to 100, you must count from 1 to 99 before you get to 100. So let's just say money is 10 or money is 100. So you have to go through 1, 2, 3, and the steps that will lead you to the end product, which is money. Now, to talk about making money in trading, your strategy is one of the things that we'll consider if you make money, but your strategy doesn't really matter. Your strategy matters a lot, but it doesn't really matter, you understand? Because it's just an edge, what you will see, that will make you act upon it. And inside your strategy, you need to acquire some psychological aspect of human nature into your strategy for you to make it more okay and perfect. Let's say you have a 30% win rate strategy, and you're trading on 30% win rate strategy, and you are making little profits from it. But if you should add some psychological aspects to that your strategy, by the end of the day or by the end of the month, you realize that your trading has improved from point B to point A. You understand me? Now, what are the psychological aspects of trading? One is patience. Patience to wait for the right setup. You might have an edge, and the forex industry, the trading industry, is all about, most times, 50% of the times, the market do give us fake outs, something that looks like our edge. I don't know whether the market knows everybody's edge and tends to give them fake outs. So there's something they call fake outs in the forex industry. It's a fake out. It looks like your pattern. It looks like your strategy. It looks like your edge, but it's not exactly your edge. So, but we tend to say that this thing looks like our edge, but because of impatience, we do enter the trade because we don't want to miss out that trade. Because we know if we miss out that trade, we will feel agonized. You understand? So we tend to enter the trade because we feel like, let us not miss out this trade. Let us not miss out on this trade. Because of impatience. But if you are a patient trader, you'll be like, if the forex industry, if the trading industry doesn't give me what I want, I will not enter this trade. I will never ever enter this trade. Let's say you are waiting for an order block, a fair value gap, a liquidity sweep, and so many other confluences that will make your strategy, that makes up your strategy. And in the end of the day, you only see a liquidity sweep, another block, and a break of structure. And you ask yourself, what is the fair value gap? And those little voices in your head will start telling you like, it's not every time fair value gap you come out. Just trade what you see, trade what you see. Then you enter the trade just like that. You might lose the trade. Let us say it goes in your favor. It happens just like going in your favor without you waiting for your full confidence. Now it has give you a tattoo in your brain. That's something in your brain that fair value gaps are not important. I'm just giving an instance. I'm not giving you a strategy. I'm giving an instance. You understand? I'm not saying if you see fair value gap or other block, you should enter a trade. No, I'm giving an instance. So let us say your strategy is liquidity sweep, fair value gap, other block, and break of structure. Then you see only 3 confluences. You didn't see one. You be like, okay, one is not that important. And you enter the trade. The trade successfully goes to your direction. It has started something in your brain that last confluence is not important. And next time you want to trade, and you do not see that last confluence, you will still enter it because it went successfully in the previous one. Now, when you enter that trade again, it will go against you. It goes against you, and you feel like, okay, maybe it's just a normal day of losing. And you enter again, it goes against you again. Enter again, it goes against you again. And before you realize that thing you did last time of not allowing your full confluences to come outside has affected you psychologically, you have lost a ton of money. You have lost a lot of money. And that is another aspect of trading where most people tend to find late. Another aspect of psychology in trading is contention. Being content with what the market is giving to you. Let's say you are taking a trade. That's happened to me several times, and I have learned from it. You are in a trade right now, and you are risking, let's say you are risking 50 pips to get 200 pips, take profit. Then it's going in your favor. It has gone in your favor 150 pips. Now, you are too naive to realize market structures to know if the market will continue going in that direction which you are trading or if it's going to reverse. And you just block your ear and say it must hit my take profit before I close this trade. And lastly, it ends up going against you. We are having expectations, unrealistic expectations, thinking that the market is our father or the market is our mother, that whatever we ask the market is going to give us, without knowing that this market acts on recurring patterns. It acts on recurring patterns that helps it act the way it does. It acts on recurring patterns and structures. So once you see a structure that the market is about to go against us, the best thing to do is to take your profit and reverse your position. That is if you want to continue trading. Reverse your position. Take the next trade, the opposite direction, and you will see it will go in your favor. But let us say there was a time I was trading and I was anticipating 350 pips take profit. And I was risking 49 pips. And the thing has gone in my favor, 220 pips take profit. I was supposed to close that trade and secure that profit, but I said I wanted to reach that 300 pips take profit. What happened the next day? Not even the next day, that same day, it reversed and hit my stop loss. It went up, past my entry point and hit my stop loss. Now I have seen it. In most cases, this causes me to start thinking that the market is against me until I form the habit of saying, watch the market structure. There are some times that I will allow my trade to go hit 300 pips take profit. And now, I've learned that there are times that you allow your trades to hit the take profit as you said, and there are sometimes you have to rethink and reverse your position for you to be in profit and secure some profit. Another psychological aspect of trading is, you see many people just come into the forex market and they place a trade. And when the trade start going in that direction, instead of them to allow this trade to go peacefully and hit or they reverse their position, once the trade starts going, they shift their stop loss to their entry position. And maybe the price wants to come up and hit a particular price level. Maybe that price level might be their entry. That price level will not hit that entry, and now the entry has been shifted to the stop loss. The stop loss has been shifted to the entry. And now when the price hits the entry, they have been stopped out. The price might eventually come down and hit their take profit, but they have shifted the price, their stop loss to their entry, and it's going to cause them to stop out. Sometimes it's good to shift your stop loss to your entry, but it's not important. It's just like telling your brain that I didn't accept this risk, that this amount of money I'm risking. You're risking $500. You're risking $500 to make $2,000. That is 1:4. And you place the trade. The price is going to your direction. Maybe you're already $750 profit, and you shift your stop loss to your take profit. So you have shifted your stop loss to your entry position, and it goes to your entry, and price decides, okay, let it just go up a little bit, play around and come down and hit your take profit and give you the $2,000. But because you have shifted your stop loss to your entry, it hits your entry and you are stopped out, and price ends up going to your direction, and you start agonizing again and start saying, no, what have I done? The market didn't do anything, you did it to yourself. So the psychological aspect of trading is really, really important. Your strategy is really important, yes, I won't lie to you. But psychological aspect of trading is one of the trading patterns that newbies don't want to understand, and they end up learning it the hard way. Markets end up teaching them, and they learn the hard way. So that is just what I want to talk about, the psychological aspect of trading. So guys, make sure you read a lot concerning psychological aspect of trading and learn from your mistakes. Don't think that the market is against you. It is never against you, and it is never against anybody. The market is doing its thing. The market is doing trading stops, and you are doing human stops. You have to think like a trader to make money from trading. So that is what I want to say about this video. Thanks so much. It's still just your favorite forex guy, Chukwu. Stay blessed.